If you're wondering what you can do to reduce future required minimum distributions, then in this video, I'm going to share 4 ways in which you can potentially reduce your future required minimum distributions when you reach age 73. Welcome back. This is episode 248. Many of you are probably still working on getting your taxes filed by the April 15th deadline for the 2024 tax year. And I'm sure some lucky listeners have already filed. Congratulations. But regardless, April is a great time to think about tax planning. Taxes are already on your mind. Why not continue, in that mindset? And in particular, planning for any upcoming required minimum distributions. And if you don't know what that is, when you turn age 73, if you have any IRAs, 401ks, 403b plans, 457 plans, or any other non-Roth retirement accounts, the IRS says that you then have to withdraw a minimum amount of money from those accounts starting the year that you reach 73 and report it on your income tax. Now, many people think it's a good idea to wait until they reach 73 to begin withdrawing from these accounts, but waiting can create a massive tax burden. Some people even refer to it as the tax tsunami or the tax bomb. So in this episode, I'm going to cover the basics of RMDs, talk about how they work, and also discuss 4 strategies that you can use to reduce this potential tax tsunami that awaits you in the future. Now, firstly, I want to thank all my loyal listeners. I thank all of you for continuing to listen and support the show. But as I've been saying the last couple weeks, I want to reach even more people. I want to educate as many people as I can with this podcast. And to do that, I need more listeners to leave me reviews. Reviews are a way that people find podcasts. It's a way that it helps give your podcast visibility. So I would greatly, greatly appreciate if you could help me if you haven't already done so, or maybe you did it a while ago, but leave me a review. One way to leave a review is on Apple Podcasts. That's where a lot of people listen to my show, and also a lot of people listen to it on Spotify. So with Apple Podcasts, you'd have to pull out the Apple Podcast app on your phone. So get out your iPhone, pull out the podcast app, scroll or search for my show if you're not subscribed to it. Then you click on the show itself where it says Retire with Ryan, scroll down to the bottom where you see ratings and reviews, and tap to rate. If you listen on Spotify, it's easier. You just, again, would search for my show by searching Retire with Ryan, then scroll to the top and click on rating. It's that easy. So if you've already done this, thank you very much. If you haven't, I would greatly appreciate it. It just takes a minute of your time, and it really helps me to increase visibility of the show and to help even more people plan for the perfect retirement. So, as I mentioned, the focus of this episode is required minimum distribution, or RMD for short. So as I said before, once you reach 73, any non-Roth retirement accounts that you have to start taking distributions from them. The only exception to this is that if you're still working for a company in which you have retirement funds in that company's retirement plan, and you're not more than a 10% owner in the company. So if you're still working for a company, you're not more than a 10% owner, and you're planning to work there past age 73, you could actually wait until you retire from that company. Or if you are one of these workaholics who dies at your desk, then your family would then have to start RMD distributions, the year after you die. However, for everyone else that's not going to work until 73 and beyond, the RMDs would start at 73. So what the IRS says is that you have to look at the value of these accounts as of the prior year end. So for example, if you were turning 73 in 2025, you would look at the 2024 year end balance, and that's the number that you would use to determine how much of a distribution you take. So that's step 1. You find the previous year end balance for all of your non-Roth retirement accounts. Step 2 is that you look up one of the 2 IRS required minimum distribution tables that tell you the factor that you use to calculate that distribution. So there's 2 tables. The most common one that people use is called the single life expectancy or uniform table. And that is for people who are single or married to someone who's within 10 years of their age. So if your spouse is not more than 10 years younger than you, or you're single, you use the uniform or single life expectancy table. The second table you use if you're married to someone who's more than 10 years younger than you. So those are the two tables that you would consult, and I'll put a link to those in this episode. Again, this is retirewithryan.com/podcast/episode 248. And then what you do is you take that prior year-end balance, and let's say it was $100,000 in your IRA, and you divide by the factor that would correspond for you. So if you're using the single life expectancy table, that factor is 26.5. So that works out to 3.77%. So that's how much your starting distribution would be for the year you're turning 73. And then if you were to look at one of these tables, your percentage is going up every year because the factor, the divisor, is going down. Now, if you're, as I said, married to somebody who's less than or more than 10 years younger than you, then it's a little more complicated because you have to find your age for that year and then the age of your spouse. So I have two quick examples. Let's just say you're 73 and your spouse is 62, therefore they're 11 years younger. Your factor would be 27.2, which equals 3.67% withdrawal for that first year of required minimum distributions. Let's say you're married to somebody 20 years younger than you. You're 73, and in the same year, your spouse is going to be 53. Then your factor would be 34.2, which equates to a 2.92% required minimum distribution. So that is how you calculate the distribution. Where I see some people mess this up is that if you have multiple IRAs, you can actually aggregate IRAs for the purpose of determining how much you have to take. So if you had 4 different IRA accounts and they collectively added up to $200,000, you could choose to take money out of one of those accounts to satisfy all 4 distributions. You don't have to take money out of each of them. You certainly could, but for simplicity, maybe you say, I'm just going to take money out of one of them. However, if you have multiple 401ks or multiple retirement plans, non-IRA accounts, you have to actually take money out of each of those. You can't just say, I have 3 old 401ks, one with Aetna, one with Connecticut, and one with United Healthcare. I'm only going to take money out of the United Healthcare one. That doesn't work. So that is a further reason to think about maybe doing an IRA rollover when you retire. Consolidate these 401k accounts into one place, or retirement plans in general. It becomes a lot easier to manage the distribution. So if you don't take out that distribution, you then face a 25% penalty. So the IRS, when they find out that you haven't satisfied your distribution, they will levy a 25% penalty on this money. And then you have a makeup period of 2 years where if you then make up the past distribution that you didn't satisfy, the penalty will be reduced to 10%. So that penalty used to be 50%, but it's been reduced, which is great, only to 25%, and then you have that 2-year window to make up any distributions that you didn't know about or you forgot about, or something prevented you from taking them, a health issue, and that will reduce now to 10%. So that's a little bit about how required minimum distributions work. One last thing I will say is that, so the distributions, or starting with the first distribution, so when you first hit age 73, you have until the following April 1st to satisfy the distribution. So if you're turning 73 in 2025, you could wait until April 1st of 2026 to satisfy that distribution. Every year after, you have to take your distributions out by the end of the year. So by December 31st, you have to have withdrawn that money from the IRA or the retirement account to satisfy that distribution. So why might you want to wait until April 1st to take your first distribution? Let's just say that you were going to receive a large amount of income that year from, selling a property or realizing a capital gain. Then maybe you might want to wait till the following year so that that distribution could potentially be taxed at a lower tax rate. For most people, it doesn't make sense to wait because now you're going to have 2 distributions in one tax year that could potentially cause you to pay more taxes on both of those distributions. You really have to look at your income for the year. Again, plan out your income, see what it looks like, and determine if it makes sense to wait. So what are things that you can do? As I said, I want to share 4 strategies that you can use to reduce your potential required minimum distributions. Because if you think about it, if you retire in your early 60s and you're leaving your IRA and your retirement accounts alone, they're deferring, they're growing, that money could double within, a 10-year period if you had very good returns. And now you're looking at, a twice as big IRA or retirement account. That means even more money you have to take out at 73. And when you combine that with your Social Security income, and if you have a pension, any other dividend or interest income, that could maybe push that required minimum distribution into a higher tax bracket. So the first thing you could do, strategy number 1, is just start before 73. You can start at age 59 and a half taking withdrawals from retirement accounts without a penalty. So you could start at that point. If you retire early, you could start taking money out sooner. That's going to reduce what you then have to take out. This could really makes the most sense for someone who's not working. If you're still working, it doesn't make sense probably to take money out of your retirement accounts unless you have a significant retirement account that's in the multiple millions and you're going to have a really large RMD and you figure that your taxes will be greater in retirement than they are while you're working. Then it could make sense to take out the money before or while you're still working. But for many people, if you retire in your early to mid 60s, you should think about taking money out of your accounts to start the clock early rather than waiting until 73, especially if you're going to delay your Social Security benefit. If you're going to delay your Social Security benefit to the maximum till age 70, then you're going to need income probably if you retire in your mid to early 60s. So you're probably going to be taking money out of your IRAs anyway, but just in case you weren't, that could make sense to take money out of your IRA during those years. So reason number 2 kind of goes hand in hand with the first, or strategy number 2 goes hand in hand with the first strategy, and that is think about a Roth conversion. So any money you have in pre-tax retirement accounts can be converted over to a Roth IRA. Why would you want to do that? Well, you would take money out of your IRA, you'd pay taxes at your current tax rate, and then you could move it over to a Roth IRA. And then it allows that money to grow tax deferred, and then when you take it out, it's tax free. So this is a way that you could take some of your income, move it over to a Roth account, especially if you don't have a lot of money already in Roths, and then you could take it out and use it down the road as tax-free income in retirement. Or if you don't use it all and you have children or grandchildren, it could go to them tax-free and be a way that you create a legacy. So it's a great way to get some of your money that's pre-tax and move it over to the Roth side, especially if you can do that at a lower tax rate than you would be in when you reach RMD age at 73. So for a lot of people, if they have significant IRAs, you're going to have significant RMDs. As I said, it's about 3.7%. So you figure if you have $1 million IRA, that's a $37,000 RMD that you have at age 73. If you have a $2 million IRA, or you think it'll be $2 million by the time you're 73, now you're talking, $74,000 that you have to take out. So when you add that to your Social Security income and any pension income, you could be paying more taxes in retirement than when you're working. So this is a great reason to think about Roth conversions. And with a Roth conversion, you pay the tax, as I said, at your current tax rate. It makes the most sense if you can pay the taxes from other money. If you have other savings or investments that are non-retirement, you can use that money to pay the taxes. It makes even more sense. That way more money goes over to your Roth IRA and allows that money to grow even faster. Another thing about Roth IRAs is that they're not subject to RMD. So any money you have in Roth IRA, Roth 401ks, any Roth conversions that you do, those are not going to be subject to any RMDs. So that's going to be, income that you don't need to take out. And also when you do take it out, it's not subject to tax. So it's not going to count and push you potentially into a higher tax bracket. So strategy number 3 is think about donating some of your retirement account, your IRA, to a charity through what's known as a QCD, or qualified charitable distribution. I've talked about this in past episodes. So you could start this as early as age 70 and a half. So you could start it before you reach 73. Now, why would you do that? Because let's say, again, you have a large IRA, you're trying to reduce the balance so that you don't have a large RMD, and you like to donate money to charity or charities, but you're not able to get a tax benefit for that. So currently, most Americans right now are not itemizing their taxes. What does that mean? That means you're taking the standard deduction. So any donations to a charity, you actually cannot take a tax write-off on them because you're limited to $600 for most people to deduct on your taxes for charitable contributions, unless you can itemize your taxes. And that means you'd have to have more itemized deductions than are greater than the standard deduction. And that would mean a really large charitable contribution. And a lot of people don't have the ability or don't want to donate that much. But a workaround to that is, why not donate part of your RMD to a charity? You have to take the money out anyway. And by doing so, you donate some to the charity. You then are satisfying your RMD requirement, but you're not having to pay taxes on this money. And that could help you to pay less tax on your other income. And, also, if you weren't able to itemize your taxes to deduct the charitable contribution, that's another way you can donate to your church or to your favorite charity. So currently you can donate up to $108,000 in this current tax year. Now you and have all of that qualify to satisfy your RMD. So if you had a really large retirement account, you had a significant RMD, let's say your RMD was $150,000, well, $108,000 of that you could donate to a charity and you satisfy your RMD. Let's say your RMD is $60,000, but your church has a big project, they're building a wing on the church, and you want to donate $108,000, you can do that, but only $60,000 would satisfy your RMD. The rest is just extra money you're donating, and it's not carrying over until future years. So any amount that you donate above your the $108,000 or above your RMD is not helping to satisfy future years' RMDs. So you have to keep that in mind. And this is a win-win for both you and the charity. So the process is, you can't just take a distribution from your retirement account and then send a check to your charity. The money has to come directly from your IRA and then go to the charity. So you have to fill out a form wherever your money is held. That custodian has some type of a form. So if your money was with Charles Schwab, you'd fill out Charles Schwab's form. Charles Schwab then sends the money directly to the charity. That's what satisfies it. But one thing I will say is that it doesn't reflect on your 1099 that you've done this. So make sure if you do make these charitable donations, you keep track of it, and then you don't pay tax on this income come tax time, or let your accountant know, because some people do make these donations and then they forget about it, and then they end up paying tax on the money anyway, but because it's not taxable. So the last strategy is to consider using what's known as a qualified longevity annuity contract, or a QLAC. So what a QLAC is it's a longevity annuity. Most annuities that you buy, especially if they're immediate annuities, are paying you income now. So if you're looking for income in retirement and you want conservative income that you can't outlive and you don't have to worry about the fluctuations of the financial markets, you could take part of your IRA and you could hand it over to an insurance company, and they will give you monthly or quarterly payments, however it's structured, but they're annuity payments. However, if you're concerned about living a long time and what's going to happen to your income, will you have enough income if you live to 85? You can buy what's known as a QLAC. So that type of annuity only pays you when you reach 85. So you turn over a certain portion of your retirement account at whenever you want. Let's say you're 65, and then 20 years later, the insurance company would start making payments to you. So if you don't live that long, sometimes, many times I believe this money is gone. But how it helps you from an IRA RMD standpoint is that this money is not subject to RMD. So if you took a portion of your IRA and you bought a QLAC with it, from now until when you reach 85, this is not subject to RMD. So that also would help you reduce your RMD and potentially give you more income if you live longer than expected. So if you live to 85, depending on how much you put into one of these QLACs, you'd get a certain amount of income. And it's not really long-term care insurance, but it is another way to insure, for additional costs you might have as you age, And some of those costs could be long-term care needs that you have. So you're allowed to put up $200,000 into a QLAC from a retirement account and have that not be subject to RMD. So you could certainly do more, but that would not be subject to an RMD. So if you're going to do this, make sure that it's a highly rated insurance company, because if you're not going to get any money from them for 10, 15, 20 years, you want to be very confident that they're going to be in business when you are eligible for this annuity. So definitely a highly rated insurance company, probably a brand name that you know about, is probably the right way to go. So again, consider what your RMDs are going to look like when you turn 73, and maybe use one or some of these strategies that can help you to reduce your RMD so that you can manage the taxes better and maybe in the process pay less taxes. So I hope you found this episode helpful. And if you did, as a reminder, please leave me a review on Apple Podcast or Spotify. And if you have a listener question you want to have considered for a future episode, you can leave it by heading over to retirewithryan.com and clicking on Ask a Question. Have a great week, and I look forward to talking with you next Tuesday. Take care.